Boy, do we have a lot to talk about today. We're going to talk about some items in the Tax Reform Act, market fundamentals, sequencer returns, long-term care insurance, and life insurance, if that isn't enough. So stay tuned.
Retiring Well, brought to you by Centennial Wealth Advisory, financial advisors specializing in retirement planning and serving all of Northern Michigan. Retiring Well, helping you plan for a successful and comfortable retirement. Retiring Well, plan to retire well.
Hi, welcome to our show. Listen, in this segment, I want to talk about that Tax Reform Act we got in 2017, right? That gift we got about a year and a half ago. Listen, there's a couple things that came out of that I think are very important for you to understand or know. First of all, they doubled the standard deduction. Remember, that was that number that they gave you. If you could not itemize, you could take it. If you were married, that was like $12,000, okay? But they've doubled that. Now it's $24,000. Last tax season, we saw a lot fewer people basically itemizing their deductions because they couldn't get over that number. Now, why is that important to know? Well, if you're somebody that cannot itemize your deductions, but you're giving to charity, okay, you're most likely not getting a deduction for a lot of what you're putting into charity. But if you're older than age 70 and a half, okay, you're now at that place where you're required to take minimum distributions from your IRA. Did you know that you can give those RMDs to charity and it never counts as income? Think about it. You know, before I have to take the RMD, I have to take that distribution from my IRA, I have to pay tax on it. Now I give it to charity, I can no longer get a deduction. Not necessarily a great scenario, but if I can take that RMD, give it directly to charity, and it never shows up in my income, well, wouldn't you want to do that? Of course you would. Now, another thing that happened out of the Tax Reform Act is what they called these Roth recharacterizations, okay? What this is if you did not know this, you have the ability to convert any amount of IRA over to a Roth IRA. There's no limits, and there's no income limitations as well. I could have $1 million in an IRA, pay the tax on it, convert it over to a Roth IRA if I wanted to. Now, you could always do these before the end of the calendar year. But if you thought it was a bad idea for some reason, you had all the way to the second extension filing date to undo it, to basically recharacterize it, as they call it, act as if it never happened. Now you say, Larry, why would I do that? Well, think about it. If I'm that person that had $1 million in an IRA, paid the tax on it, converted it all over to a Roth IRA, and now the market drops to half its value, I'd feel pretty stupid, right? I just paid tax on $1 million, and now it's only worth half that. Well, under the old rules, I had all the way, again, to second extension filing date to undo it or recharacterize it. With the new Tax Reform Act, we no longer have that option. If you do a Roth conversion in the calendar year, you're stuck with it. So the kind of accounts we're going to want to use when you do those conversions is going to be very, very important. If you got anything out of this segment, can you see where a little tax planning would be helpful? At Centennial Wealth, we do that. So if you have any questions regarding Roth conversions or want to know if you're a candidate for it, then please give us a call.
Today's retirement challenges can be mastered. Knowledge is power because you can confidently plan ahead and make educated financial decisions for a successful and comfortable retirement. We are Centennial Wealth Advisory, financial advisors specializing in retirement planning, serving all of Northern Michigan with offices in Traverse City, Cadillac, Petoskey, and Gaylord. And we invite you to an informative and exciting live event with a complimentary gourmet dinner. You'll learn highlights of the new Tax Reform Act, the difference between the fiduciary and suitability standard of care, how an IRA gets taxed to a surviving spouse, what a bull market is and how long it can last, and much more. Call 888-608-5825 to register Thursday, September 26th at Boone's Long Lake Inn in Traverse City. The live event starts at 6 p.m. and is free to attend with a complimentary gourmet dinner to follow, but seating is limited and fills quickly. Call 888-608-5825 to reserve your seats today. There is no cost and no obligation. Don't miss this important live event. Educated financial decisions. Call 888-608-5825 today.
Hi, welcome back. Now listen, in this segment, I want to talk about market fundamentals. There's a lot to listen to out there when you're listening to the news, and everybody has their own opinion, don't they? But for the most part, you have to understand markets are pretty predictable. They'll, for the most part, will trade at a multiple of its earnings. Now, I know there's volatility. There's times when, and we've seen it in recent months, where it dropped 3% in one day. That's not what I'm necessarily talking about. I'm just saying, as a general rule, markets will trade based on the underlying earnings of the corporations. And as a general rule, historically, it's traded around 16, 17 times earnings. That means if it's much higher than that, we're most likely in overvaluation territory. And it's done that historically in the past. So, you know, if it's just done it for quite a long time, that's something we're going to want to maybe be concerned about. If it's trading below that or well below it, some might argue that's maybe bargain territory, right? Good time to buy in. But for the most part, it's going to track pretty closely with earnings, or a multiple of those earnings. So that's one fundamental we're going to want to pay great attention to. If we're in overvaluation territory, or we're in bargain territory, or if it's trading right within those fundamentals. Because if it's trading right within those fundamentals, and historically not above or below, and we're hearing a lot of bad news, is it something that we necessarily need to react to right away? It could be just a lot of emotions going on due to that bad news. Okay, so if you're a long-term investor, sticking to the fundamentals and understanding where the market's trading regarding maybe those earnings is going to be very important. Another thing to understand is when you're looking at fundamentals, you want to look at all the things that drive consumer spending, or what we call small business spending as well, because 87% of our GDP is basically small business consumer spending. So how those people are feeling about the economy, whether they're spending or not, is going to drive those earnings, which, as I just previously indicated, is then also going to drive the market. So we want to look at everything that's going to affect those earnings. For example, if we have low unemployment, why is that good? Well, it means if more people are working, they have more money in their pockets, and if they're feeling confident about the economy, they're going to spend that money, which is good for corporate earnings, again, which is good for the market. So confidence levels, how people are feeling, is something that we want to pay attention to. There's a lot that goes into market fundamentals, a lot of things we want to look at, but all the more reason you want to be talking to an advisor who's paying more attention to those kind of things. At Centennial Wealth, we do. So I encourage you, if you're at somebody and you just want to kind of see where you're at and how you're positioned relative to the market, then give us a call.
Once again, great information from Larry. He never lets us down, Art. So, but we were talking about not only taxes, but investments as well, and how important it is for those to go hand in hand. But also, Art, I think of, in our case at Centennial Wealth Advisory, how we're not just looking at the taxes investments, but then understanding an income plan. Like a lot of you are trying to prepare a plan for the long term and how that income's going to look in retirement. And just as important as that is then factoring in your health insurance plan and how vital it is for your income and your taxes to all flow through to the health insurance.
Oh, you're exactly right, John. You know, I think the holistic approach that we have here seems to be a little unique. We had some folks come in that have been relatively new clients of ours that were with another financial firm in town, and they had been retired for about 2 years and had pulling income off their portfolio. And we started to walk through this. They literally were just living off of this statement. They had no plan. They hadn't been taking Social Security as an example, but they didn't really know why they weren't taking it. And so we start mapping out, you know, what does that look like? When should you take it? You know, what does taxes look like? They missed a couple great years of Roth conversion opportunities. You know, all things that, you know, early retirees or retirees have the advantage of doing if proper planning is done and you're looking at the whole picture, right?
Sure, most definitely.
Yeah, folks, if you get anything after watching our show week after week, planning is the key. Whether it be income planning, it be tax planning, estate planning, plan, plan, plan. So many of us have questions, but we don't ever seek the answers. Encourage you to give us a call if you take advantage of any of that kind of planning. But stay tuned. We're going to talk next, about sequence of returns, another one of those financial jargons that people don't understand. So stay tuned.
NMC Extended Education is introducing an educational class titled Retirement Secrets, Your Best is Yet to Come. Our very own Larry Flynn will be the presenter. If you are nearing retirement or already retired, then this class is for you. Many things can threaten your ability to outlive your assets and retire well. The big three being healthcare, inflation, and taxes. Learn to navigate the critical issues that a retiree must deal with. You'll learn how to plan for a predictable and sustainable income, minimize taxes on your IRAs, maximize your Social Security benefits, and avoid estate planning mistakes. We'll also discuss long-term care concerns and what investments are appropriate in different situations. The cost is only $69. Materials will be provided and a spouse or guest may attend for free. The class will be held on 2 Wednesday evenings at 6 p.m. for 3 hours. September 25th and October 2nd at the NMC Great Lakes campus. Reserve your seats today by calling NMC at 231-995-1700. Again, that number is 231-995-1700. The class is called Retirement Secrets.
Hi, welcome back. Listen, in this segment, I just want to have a little bit of fun because I want to talk to you about what they call sequence of returns. Now, there's a lot of financial jargon in our industry, and you'll find that anytime we're talking about any kind of financial jargon, we want to give you a thorough understanding of what we're really talking about. Well, one of those things sometimes you'll hear people talk about is what they call sequence of returns. And the conversation I would like to have around this is, do you know that it doesn't matter the order of your returns, you're going to arrive at the same amount no matter what? And so I thought it'd be fun to kind of illustrate this on Chalk Talk to kind of give you a feel for what I'm talking about. So here's a person who has $100,000, all right, and they're going to get, in 4-year period, they're going to get an 18% return the first year, a 7% return the second year, a 12% return the third year, but then all of a sudden they're going to lose 40% in 1 year. Maybe this is like a 2008 or something. So you follow me on the math. The first year they make 18%, 18,000. They now have 118,000. Second year, 7%. They're now at 126. Third year, 12%. They're now at 141,000. And by the fourth year, now all of a sudden they lose 40% in 1 year, lose 56,000. But they're at 84,000. Now, what if I was to reverse that order? So the first year, instead of the last year losing 40%, what if they lost 40% right off the bat? And then in reverse, got 12% the second year, 7% the third year, 18% the fourth year. So let's look at that. How would that come out? Well, first year, I lost 40%. I'm down to $60,000. But now I start to build it back up. I get 12%, I get to 67.2. 7%, I'm now at 71,000. Now by the fourth year, 18%, guess where I'm at? $84,000, the same place. It didn't matter. Changing the frequency of the returns had no difference. Now, why is this important? It's just important to understand that, that's the way the math is always going to work out. Now, some people, in fear that they're going to get a big negative, might want to take a little bit more risk on than normal because they think if I can just get some bigger returns in the early years, that'll make up maybe for that negative year. I'm just going to tell them, I'll talk to them about sequence of returns and say, listen, the sequence of that doesn't matter. Whether you get the first year or the last year, the math is the same. So again, just thought I'd have a little bit of fun with you on that. Isn't it interesting that that's the result no matter what? So anyway, hope you found that valuable. Was a little fun. But if you want to know how maybe that affects you and your retirement and your planning, then give us a call.
Hi there, my name is Nick Greenman. I'm one of the financial advisors here at Centennial Wealth Advisory. Brand new to the Gaylord office. I'm here full-time now, and I'll also be commuting back to the Petoskey office as well. I'd love to hear your story and learn if I could help you manage your retirement needs.
Hi, welcome back. Listen, in this segment, I want to talk about long-term care. Listen, if there's any question that we get asked more times than not when somebody comes to visit us, it is, do I need long-term care insurance or not? Well, the first place I want to go anytime I'm having this discussion is, what is your means to pay for that care should it happen? If I'm somebody that's saved quite a bit and it's more than enough to cover the costs of that care when that should happen, then really do I need anything more? If I'm somebody that might be legacy minded and want to leave a lot behind and want to protect some of that, well, then that's a whole different story, right? But if I'm somebody that's saved sufficient amount away, then maybe I don't need to have any kind of insurance. We call this self-insuring. Now, just to give you a perspective of what that might look like, I've heard statistics be all over the place on this, but I've heard anywhere between 3, maybe 5 years is the average stay in long-term care, and probably the average cost being somewhere around $100,000. So what's the threat to my estate in that regard? Might be anywhere between $300,000 and $500,000 should I need that kind of care. And that's just for one person. What if I'm what if I'm a couple that's even twice that? But if I'm somebody that saves sufficient amount aside to pay for that care and I can cover that, then maybe I don't need anything more. But if I'm somebody who has not, then I'm somebody who might want to consider long-term care insurance. Okay. Now, the only drawback to long-term care insurance is there's a cost that I'm going to have to incur to pay for that insurance. It's a cost that might rise as I get older. Some do, some don't, but it may be one that grows the closer I get to needing that. The other negative maybe with long-term care insurance is that it's a use it or lose it. I'm going to pay for that insurance for quite some time, and then I get close to maybe needing it. Maybe I can't afford it, and now all those premiums I paid have gone for naught. But today, folks, they have what they call hybrids, and hybrids are the ability to take a segment of your savings, put it aside for that kind of care. Maybe it's a lump sum. It goes aside for that care, and then it's insuring me for that benefit. And then if I don't need that long-term care, there's usually some kind of a risk, or I should say a premium payback. Okay, that might, it's not going to get the kind of growth you might have had maybe in an investment account, but at least it's a return of premium. I get a lot back of what I set aside. So there's a lot of different features with these hybrids, but it's something, just see another example with life insurance. It's got a death benefit, but can be used for long-term care. And then if you don't need it for long-term care, at least it paid a death benefit out. So a lot of different features here, a lot of moving parts, but it's something you might want to check into, because if it's not typically just long-term insurance, maybe it's a hybrid that might be more beneficial. Well, I hope you found this valuable. If it's something you want to talk more about, then I encourage you to give us a call. We'd be glad to talk more about it with you.
Larry, I think it's great that, kind of every show you've been introducing some of these financial jargons that we use out there and people may hear, in the media or different sort of stuff. And so this sequence of returns that you're talking about, it's kind of interesting how you played out the story there. But the one thing that you didn't talk about that maybe is really important to our listeners as retirees is what that would have looked like if you would have had withdrawals coming out of there. If you'd have been pulling a paycheck from that, how that kind of changes the story and it starts to be a little different. Think about what we call withdrawal rate. It's the percentage of the amount you're pulling out per year. If you're pulling 4 or 5% out and you have a loss from that, that withdrawal rate gets bigger. So those early losses, especially in the early years, can really hurt you. So the importance of having a low volatile portfolio while you're taking income can really help the longevity of your portfolio. So John, I know you're going to talk a little bit about long-term care here and the importance, but not only just once again from a retirement approach, having considered that and having a plan for that is vitally important.
Yeah, coming back to what Larry said earlier, talking about plan, and that's the biggest thing with long-term care. So often we're sitting down with folks and they're telling us, Yeah, I'm concerned what long-term care is going to look like for me, and you know, they've had experience with their parents and saw what they went through and some of the challenges that them as children were dealing with, and unfortunately we've seen it recently with clients where they had the older types of more traditional long-term care policies where you're paying in your monthly or annual premium, and they've continued to see those premiums increasing more and more. And it's getting to a point where maybe they can't afford it anymore. And so that's where there's a lot of other alternatives that are available today that we like to help evaluate when it comes to your long-term care planning. So we encourage you just to give us a call to talk through that.
Yeah, John, I'm glad you brought that up because, I mean, long-term care insurance in itself is not bad. I mean, you're buying insurance to insure for an event that you're hoping doesn't happen. But boy, when they keep raising the costs and then you're having that conversation with somebody who's saying, I'm not sure I can afford this anymore, and they've been paying into it for a lot of years, that's not a good scenario. Well, anyway, stay tuned because in the last segment, we're going to be talking about life insurance and the value of having it when you're younger, but as you get older, there's just as much value, so stay tuned.
NMC Extended Education is introducing an educational class titled Retirement Secrets, Your Best Is Yet to Come. Our very own Larry Flynn will be the presenter. If you are nearing retirement or already retired, then this class is for you. Many things can threaten your ability to outlive your assets and retire well. The big three being healthcare, inflation, and taxes. Learn to navigate the critical issues that a retiree must deal with. You'll learn how to plan for a predictable and sustainable income, minimize taxes on your IRAs, maximize your Social Security benefits, and avoid estate planning mistakes. We'll also discuss long-term care concerns and what investments are appropriate in different situations. The cost is only $69. Materials will be provided and a spouse or guest may attend for free. The class will be held on 2 Wednesday evenings at 6 p.m. for 3 hours, September 25th and October 2nd at the NMC Great Lakes campus. Reserve your seats today by calling NMC at 231-995-1700. Again, that number is 231-995-1700. The class is called Retirement Secrets.
Hi, welcome back. Now listen, in this segment, I want to talk about life insurance. Now, when I was a younger man and I had my family, my wife, and 3 kids, I found great value in life insurance because one of the fears I had is if anything ever happened to me, would my family be taken care of? So life insurance had great value to me when I was younger so I could take care of that situation. But as I got older and I started to accumulate some assets and my kids grew up and they went out the door, I didn't necessarily see much value in maybe having that anymore. I maybe had some because if I wanted to leave a legacy or maybe leave more behind, then maybe I should keep some of it. But other than that, what was the real value? Well, there's several different reasons why you might want to consider life insurance in your planning. But let me just give you a couple to kind of give you a feel. First of all, let's say I'm that person who's a couple, we're both maybe drawing Social Security. Well, if you didn't know this, Social Security, when one spouse passes away, the surviving spouse gets to keep the higher of the 2 Social Securities, but they're going to lose the lesser of them. So that's income that's going to be lost in the event that something happened to that first spouse. What if they have pension income? And maybe it doesn't have full survivor benefits, meaning the surviving spouse gets to keep all of it. Maybe they only get part of it. Maybe it's only half. Maybe it's 3/4. Well, the difference is going to be lost income. So they might lose some of the pension benefits. They could potentially lose, they're going to lose the lower of the Social Security, right? That's all lost income. Well, what if I had life insurance set aside to give that surviving spouse a death benefit that could replace then that lost income? That would be a good reason to maybe have life insurance to take care of that kind of event so that surviving spouse doesn't have to change their lifestyle in any significant way. Another reason you might want to have life insurance is, let's say I'm in a high tax bracket and I really want to convert a lot of my IRA maybe over to a Roth IRA. okay, because it's going to be a non-taxable benefit to my surviving spouse, but I don't want to pay tax on it now when I do the conversion into a Roth IRA because I'm maybe in a higher bracket and I don't want to pay all that income tax on it at the present time. Well, what if I had life insurance set aside so that it paid a death benefit that could be used solely to buy out Uncle Sam on my IRA when that event happened? Wouldn't you find that a valuable thing to do? So life insurance can have some great value when you're younger, but has also some value as you get older in our planning. So if you're somebody that wants to kind of maybe talk or take a look at that and see some reasons why it might be part of your planning, then give us a call.
We look forward to helping you plan to retire well.
You know, Larry, I appreciate you bringing up life insurance. I think it's really powerful to talk about. You know, it's interesting how folks tend to, forget about it when they start doing planning. Oftentimes, we talk about this, and it tends just to be one of the last things people think, oh, I got this policy laying around, or I don't need that anymore. They quickly discount it without thinking through that. And I want to just remind everybody, this is life insurance. So anytime we're talking about long-term care insurance, life insurance, these are all insurance products. So a little bit different than some of the other stuff we talk about, but all of kind of revolve around that insurance umbrella.
Yeah, and it makes me think of, guys, as far as there's a couple that I've been meeting with here lately, and they're in their early 50s, and they're basically planning on retiring in about 10 years. And so we were talking through this idea of looking at, hey, they're interested in maybe a death benefit, but then there's sort of that concern, what if long-term care happens down the road? And so that's where we refer to some of these hybrid plans, where there's the ability for life insurance companies to structure the life insurance policy to have a tax-free death benefit, but then the ability ultimately, if a long-term care situation occurs, to start drawing from that death benefit to help pay for some of that long-term care. And so then the way that we are looking at this as well is their desire of retiring in 10 years meant, hey, we don't really want to be paying premiums for the rest of our lives on this, so how can we structure this to have the policy paid up for in 10 years? So there's a lot of different things that go into looking at life insurance with long-term care, so that's ultimately something that you want to be talking to somebody that is very well educated in that area.
Isn't that true, guys, with just financial instruments in general? I mean, there's so many out there, and they all have different pieces to them. They all have pros and cons. And for somebody that's not, familiar with those kind of instruments, it can be kind of complex. It can be very confusing. So I think I find this even to be true with people that already have products. Right. And then they don't even know all the features. They got a contract, and it might be that thick, and they've never gone in and looked at it. Right. So I think it's so important, if that's you, if you want to have a better understanding for what might be out there, what's available. Maybe it's these hybrids, maybe it's just what you have itself and want to know what you have. Then I encourage you, give us a call. And thank you for joining us again this week on Retiring Well.